down the hammer and pick up the pencil. You're about to listen to the Savvy Radio Show. Learn from real-life real estate investors, experience revealed with the Savvy Landlord as your host.
Oh, shucks, you're back. I can't believe you made it. You tuned in. You know why? Because my man Pat Pointon is in the building again. And he slapped me on the last episode. He's like, man, that's enough of this raw land deal. Let's talk about creative financing. I'm like, Mr. Pat Pointon, you are right on the money, big dog, because that's exactly where I'm at with my own life. I did creative financing in the beginning. That's all. I was uneducated. I thought that's the only way you could do it because I had no job, no income. Then when the bank started loaning me money, I got lazy and I started borrowing money from banks, which wasn't necessarily good or bad, but I really fell in love with banks. I still love banks, but I realized I need to take my game to the next level with no limitations. And how do you do that? Through creative financing. So I have got my sidekick. Actually, I'm his sidekick because he is the master of creative financing, the master of the original Real Estate Magic radio show, Mr. Pat Pointon. Over 100 creative deals or more.
Oh, yeah.
Okay.
Yeah. Sure.
So a couple quick questions. You got to structure. We're going to talk about structuring the deal, private money mixed in there, and then options. So when people say creative financing, the first thing I would assume they would think of, Pat, is that someone is carrying back a note. But that's not necessarily true because there's different forms of creative financing. Briefly, and I know that won't be easy, tell me, throw out creative financing or creative terms in general. Like
I look at it as options.
Options.
I look at a house and I decide I'd like to have this house. Now the options are, how can I pay for it?
Okay.
The first way would be to buy it subject to its already existing mortgage, which would be to take over their payments in short term.
So the people that own the property now currently,
they
have a loan with someone, a bank or a government institution, but they're paying someone a mortgage payment.
Right.
And you would
They would deed me the house, and I would assume their loan. Now, when I say assume, I don't mean that I would sign any papers to do so.
Put it in your name.
I would have them deed me the house, and I would send the payment off
to their mortgage
company. I would not actually sign any mortgage papers.
Now, devil's advocate, well, I didn't sell you the house, Mr. Pat Pointon. Why? I mean, can the mortgage company or bank get frustrated with you?
Sure they can. They want the house back bad enough. But remember, I didn't pay anything for it. Just took it over.
Right. Now, is that your rule of thumb? Like, I actually just did a subject to recently, and the numbers are not as good as I would want them to. I thought it would rent real quickly. It didn't. I paid them $1,000, and I paid an assignment fee of $1,000 for the wholesaler. And so I've got $2,000, and then I got 2 months of payments, which is about $800 each payment, because this is worth $115,000 house.
Where's it at?
It's on the northwest side, 42nd, and it's kind of in the War Acres area.
Mm-hmm. Okay.
It's a nice area.
Yep.
3-bedroom.
Okay. Key ingredient. You want to buy these kind of houses in good areas.
And it was rent ready, but I couldn't rent it. I don't know. That's probably my property management problems that I have on a daily basis. But, I mean, I'm running the numbers on this deal. My payment, taxes, insurance through their mortgage. Now, I can probably get the insurance cheaper because I got the super duper insurance on there. Is $808 a month, and I thought I could rent it for $12. Couldn't rent it for $12. Dropped it down to $11. I got it at $1,000 right now. Because now that would yield me roughly $200 a month. That's $2,400 a year. It's going to take me almost 2 years to get the ball rolling, any income back.
Well,
but
you're allowing for some things you're not allowing for.
Okay, tell me.
Number one, if you bought it in the right area, you can expect a 3 to 5% per year appreciation in its value.
Go wisdom.
And you can see some reduction in the mortgage balance during that time.
True.
So you may have a $5,000 or $6,000 profit easily on this house.
Okay.
That you can add to your $2,000 that you took to
This is
break
awesome.
even.
This gets into, yesterday you were bummed, and I've been bummed on this property. And then you just gave me juice because,
you own that property 5 years, you may be very happy with it.
Yeah, and you're right. You know why? Because the interest rate on that thing is only 3%.
Oh, my God.
It's like 3.
If it's 3%, I would never sell it.
Okay, here's the thing that I thought that was
I would
interesting.
never pay it off either.
No, we're deviating from the wholesale, from creative financing here. So let's just answer this question, then we'll get back into it. It's a Penny Mac loan. Do you know what that means? Is it like a subsidiary of Franny Mac, or do you know anything about Penny Mac? That's who I'm writing the loan to. I mean, I'm writing the check to.
No, I got a feeling it's not a government agency.
I think it is. I don't know. I heard it was a good loan, but I don't know.
Well, if it's fixed rate,
yes,
and it's 3%, it's a good loan. I mean,
yeah, it's like 3.5, 3. It's under 4.
Okay, here's my point. There are some companies. IndyMac used to be a big one out there. IndyMac was no more a federal agency than I am.
Okay, I got it.
It just sounds good.
Okay, no, great marketing. Okay, back to the creative financing. So there's options. What other options are there? You said that there's subject to existing
that would be
orders.
one.
Okay, what's another one?
Another one would be, and that's one of my most key ones, is to see if the seller won't finance it.
So let them be the bank.
Let them be the bank. Now, they would have to have it free and clear or nearly free and clear. Otherwise, it'd be a subject to. You know,
or a wraparound mortgage.
No, that's what I say. If it had a huge balance, it'd be a subject to. If it had a small balance, it would be a wraparound mortgage where I paid them and then they paid the mortgage company.
Right, and I've done that. And actually, I've gotten burned on that once before. I paid a guy off and.
There's some safeguards that you'd have to enact to do that, and we can go into those as much detail as you want.
No, I mean I think we can.
Right now, I don't. I just soon go on.
Let's get all the options out. So you got subject to create they hold the mortgage for you. Okay, let's side note right there. Is it hard to convince them? Not necessarily convince them is the right word, but to get them to agree upon the owner finance?
Sure. Many times it is. But at the same time, what I would do is I would prepare this contract, and I would prepare an amortization schedule, and I would show them how much money they're going to make over the next 15 years or 20 years or whatever, because we all are greedy individuals to some degree, some less, some more.
It's true.
So I would appeal to them that instead of getting $50,000 for this, in essence, you're going to get $80,000.
Yeah. I love that technique. You know, man, you just slapped me in the face, Pat. I'm glad that you came in today because I have been working on an owner finance deal from an 86-year-old retired landlord. He's been doing it for 40 years. I mean, he's owned this house I'm trying to buy. He's owned it for 40 years, and I'm trying to get it from him. And I did the dual offer, but he was fixated on this price, and I finally got him negotiated him to it. But if I would have just printed out 4 pages of an amortization schedule and see that he's going to make $90,000 off of his $45,000 asset that he's paid off 10 times over.
There you go.
I like that. So there's your tip, ladies and gentlemen, boys and girls around the world. Print out the amortization, and it works.
And it takes just 2 minutes with your computer.
You can find it on a website. Okay, so you got owner carry back. What's another creative financing deal?
You could use a private investor, and that would be somebody that wasn't a member of the ownership of the property who made a mortgage to you that you used to pay the owner of the property.
And that
off.
could be in several ways. That could be in a passive magnitude, like they just loan you the $80,000, let's say.
That's generally what I do.
Or with a partnership of sorts, like maybe a JV. It's a joint venture.
You could do that. If that would be just a matter of how you wanted to structure it and how you were able to find an investor who wanted to structure it. I tend to do passive investors because I can make the most money.
And speed.
But sometimes I do a joint venture. I have a joint venture going now on property. And they can be all right. And they can be advantages to one or the other.
Do you declare who's in control?
Oh, absolutely.
Right.
It's always me if I'm buying the property, let's face it.
Yeah. I mean, there's nothing. I agree with you. I was in a partnership that I just dissolved, and it wasn't a negative situation. There's some things I would have done differently. Basically, who's the one that's going to be the leader of the situation? Constantly, we were back and forth. What should we do? What should we do? How should we do it? Where should we do it? Who's going to hire the accountant? Who's the accountant? Which accountant? Your accountant's $750. My accountant's $500. I like mine. I don't like mine. Yeah. And it just drove me bananas.
Somebody's got to drive the bus.
Mm-hmm.
And every vehicle that you get in only has one steering wheel.
Right.
That's your deal.
Right so there. Do you communicate that on the front end? Do you have like an addendum to some agreement?
I write a joint venture agreement, and it has who's going to do what.
Man,
that's as simple as it gets.
There's 2 documents I'm going to twist your arm on. That's one of them.
Right. It's a very simple agreement, but it says clearly you're going to put up $50,000. You're going to clean the trash in the yard. I'm going to paint the living room. We're going to split the profit 40, 60, or whatever we're going to do, and that's that.
So it's just a basic document written together, signed.
Not hard.
Right. There's some interpretation, probably confusion later, but at least it's a start to get the ball rolling.
The more complicated the transaction, the better. And what I'm saying is that a bigger transaction is going to take more complicated paperwork. A simple house that you might do with somebody, probably I can do it in a page or two.
Right.
We're just going to stipulate what they're going to do. Generally, what I have them do is they put up the money. I do the work. We split the profit. That's usually my joint venture.
Right. They put in all the money. They're passive. They don't say anything.
I do all the work, make all the decisions.
Okay, so on this creative, we're talking about creative financing. Are you talking about flipping your deals, or are you talking about creative financing also as a hold? Or
you could do either one.
Correct. But what do you prefer?
I prefer flipping them. I'm not real good about holding them because I don't really like rental property because I don't like renters.
Right.
Now, that's just a personal thing. Generally, when I'm renting property, I'm renting it because the market has turned south on me, and so I am not able to flip it for what I want. So I just rent it until I am able to flip it for what I want, and then I flip it, and then I either sell or carry it or whatever. I really like to either flip them or do sell or carry rather than be a landlord.
Well, when I was living vicariously through my mentor that was being mentored under you, your scope was have them all lease purchases.
Oh, that'd be better. Always, if I can do that, that's what I do. Yes, sir.
And to this day, you're still doing that type of business model, unless you cannot sell it.
Yes.
And and I actually, you don't know this how much impact that you've made, Pat. But I had a deal that I bought, $150,000 house in Forest Park, could not sell, and I was desperate. I mean, it came with a duplex in the back. It was on a cul-de-sac. I'm like, this is a smoking deal. I bought it for $125. The duplex alone is probably worth about. Today worth 90, back then worth 60, and I was like, man, I'm gonna buy it, flip this big house, 3,000 square foot in the front, keep the duplex debt free, and live my life. And guess what? Couldn't sell it. Desperate. I mean, to the 10th degree, and I have a tenant buyer in there right now, or it's actually a lease purchase, not even a true tenant buyer. When people mentioned words like tenant buyer, owner financed, or subject to, or contract for deed, how do you educate people on which is the proper one to choose, or do you universally, or is it means all the same to the true investor? Because you really don't own anything anyway. It's just the form of control.
I feel a contract for deed is a stronger document than a lease purchase or a lease with option. Now, a lease purchase and a lease for option, you have to be careful between the two. We're getting off on a side trail,
right? Because that's the Dodd-Frank situation.
Well, and not only the Dodd-Frank, but here's the thing: if you have a lease with the option to purchase, you don't have to go through with it. You're not bound to. You can just forfeit your option money and walk away.
Dissolve it.
Where you have a lease purchase, so much of your payment is being applied to the purchase price. It's really more like a contract for deed.
Okay, let's go over them again. So it's a lease purchase.
You could have a lease purchase where, like, if you leased it for 15 years and then gave me $5,000, you'd own it or something. Right. That could be a lease purchase arrangement. You see that more in commercial property than you do in residential.
Okay.
Now, you could have a lease with option, which says you pay me $700 a month, and anytime in the next 3 years, you can buy this property for $90,000.
So the option is just freezes the number.
That's right.
In the lease purchase, the money goes towards.
Some of the money goes towards the purchase price,
and it's allocated in the document.
Exactly.
$300 is going towards the principal.
Right. If they on the lease option, they can walk away by forfeiting the option money. That's what the option says.
Okay. All right.
And
so we don't want to overwhelm people today.
Back to what I was going to say. And the final thing you could do would be to have a partial owner finance, where you might, let's say it's a $100,000 house, and you've got an investor, but the investor's only got $75,000. So you put their $75,000 down, and the owner carries back a $25,000 second.
Yeah, so let me tell you about a no money down deal that did that. So I sold the property to a savvy investor, and he actually paid full price, which I thought he would negotiate. But in his contingency, his question, he's like, I need you to carry back 20%. And this is like a $60,000 house or something. It was like $10,000 or $15,000.
$12,000.
Yeah, $12,000. Exactly. And that amount of money was really my profit on the deal. But I wanted to dump this property because it was becoming a headache, and it was in a rough part of town. And I was like, yeah, no problem. So, yeah, I'll carry it back. You're dumb. Because if you would have just offered me $12,000 less,
you'd probably just taken it.
I would have just taken it because I've depreciated this deal down. It was just, the
time to go.
It was more of a personal situation. So, and he's like, yeah, we're going to close. So I'm like, no big deal. I'm thinking this dude, why carry back 20? Why bring $40,000 in cash, $50,000 in cash, and have me carry back. We'll come to find out, I'm like doopy-doo savvy landlord guy. He knows everything. Book author. Yeah. I walk into this closing, and he has a loan on the property. And this bank is it's socially, I guess, policy okay that the seller could carry back the 20%. The bank didn't care about where that 20% came from. That's the point. The point is that the bank loaned 80% of ARV on that property, and the 20% the bank didn't even care about where it came from, and it came back from the seller. So this savvy investor got that property a no money down deal. Mm-hmm. And that's the same concept that you're talking about. Instead of having the seller carry back that bridge, that gap of what's due.
The difference there is he was using an actual bank. Most of the time, I would have been using a private investor for my first mortgage money.
Right. And that's I think the ultimate goal as a real estate investor in general is to keep it moving in the private world of money, because it's accessible. There's not really regulated. You don't need an appraisal. You don't need a credit check.
Well, you may or may not need those things depending on how you do your business, but you can provide as many of those items as you want, or none as you choose, and how your investor's comfortable. And generally what happens with me is they may want some stuff on the very first one, maybe even the first couple, but after they've done 5 or 10 or 15 deals with me, we stood on the phone.
These people that you're working with creatively as your private lenders, are they stick money in and they want it back out, or do they want a long-term return?
Well, most of the time I do a 5-year note.
So you're locked in for 5. That's good.
And they're not. They can see the light at the end of the tunnel if they want their money back. It's 5 years, and many times I'm able to replace them with another investor if they have some sudden reason like medical or something that they need their money. But in the meantime, I'm not having to find money in 12 months or 6 months or something like that. And that 5 years gives me time for the property to depreciate in value, for me to sell it, or me to find better financing on it, or whatever the case might be.
And let me tell you about this 5-year thing that I just learned the other day. I just did my taxes. And in the state of Oklahoma, if you hold the property for 5 years, you don't pay capital gains tax on state tax. If you sell that property within 4 years and you make a profit on it, you got to pay state tax on it. If you hold the property for 5 years. I thought that was interesting. I wish I would have known that before, because I actually sold that effing property a month before the 5.
Oh, uh-huh.
Yeah, thanks, CPA. Appreciate you for, give me a heads up. But I mean, it's not really their fault, because I just decided to sell that bad boy randomly.
Well, it's just one of those things. I structured everything on 5 years. Now, you could do whatever. Now, the longer you make your investor wait for them to get their money back, the less investors are going to be able to do it. At the same time, I don't want it to be so short that I'm strapped all the time trying to refinance existing properties.
What AM do you give that investor?
I give them normally I give them a 15 or 30 year AM, depending on what they want. I just kind of structure it for what I think the house will bear. A lot of the time, it depends on the house. Give me an example. Let's say it's a house and I know I'm going to sell it, and I'm going to sell it, let's say, on an owner carry. And owner carry, let's say I give them 3 years. Well, I'm liable to AM it at 30. Right. And the reason I am is I don't care. I'm going to pay it off. I'm making my money on the profit up front that I'm getting.
And you get that cash flow.
Yeah, and that profit up front. I'm not really worried about
their
debt reduction. Now, if it was one I was going to keep and leave to my grandchildren, right, I'd AM it on 15 years. You see what I'm saying?
But if you do a 30-year AM, you're not making as much.
A couple $1,000 on 5 years. That's all you're putting in there. But I'm getting a bunch of cash flow.
Well, their payment's lower. How are you getting more cash flow?
Because I don't give them the low payment. I raise the rate and give them the payment.
Oh, you're okay. The person that you're paying back.
I'm increasing the spread.
No. I get it.
Because I'd rather have the spread today than money down the road in the form of equity.
Yeah, ultimately, I'm switching gears. I'm trying to turn everything into 20-year AMs.
Now, the other thing is, and it's something to think about here, you're thinking from an owner standpoint, not a seller standpoint.
Right. That's what I was confused.
Now, here's the other thing. About 40 to 50% of the people that seller finance with you don't close. They walk away.
Yeah.
Okay, you paid on it for 4 years and you've walked away.
Yeah,
I've got your cash flow in my pocket.
Yeah. Oh, I love it.
But I've still got the note. I'm paying my note. The house gone up in value, and I've got your cash flow. Okay. I'm good.
We're on the creative financing thing. Tell me about cycles. You're 70 years old. You're still vibrant as you can be since you started. you've seen some downturns, you've seen some up markets. Has creative financing been more desirable at a certain time frame or certain year, or has creative financing been consistent throughout the years?
It's pretty consistent. Obviously, when the market tanks, sometimes the creative financing explodes. When the towers went down in 2001, I had a year's waiting list of investors that were waiting to put their money at work with me.
You know, I noticed today that a lot of people feel that way because the interest rate's only 1%, or, well, now it's up to 1.25%, 1.5% the other day. I feel like people are listening to real estate as an investment vehicle.
Sure, they should be, because real estate has 5 unique qualities that nothing else has. We can do a whole show on the 5 ways that real estate's unique, because it is unique compared to any other investment.
Ooh, we're at 20 minutes. So, okay, what else creative financing that you've, do you usually tend to pull cash out?
It depends on what I'm going to do with the property.
Okay.
Sometimes I do. It's not uncommon for me to finance with a private investor and finance 100% of the repair cost and possibly $5,000 or $10,000 above that if I want it. It just depends on how much that damages the cash flow, and I'd make a decision on each property whether I want to take it out or don't. But if I take it out, one of the good things is I don't have to pay tax on that money because it's borrowed money.
Yeah, I mean, that's my goal now, is to pull out as much within reason, just in case I leave enough room. If things do go south, property managers do disappear, things do happen. But I try to pull out as much as possible and put that money, that $20,000 I may get at closing, may take the $10,000 for the repairs. I may take that other $10,000 and put it to work and buy another property.
Yeah, I've done that many times, sure. Yeah,
right.
Exactly. And that's a creative. And the last creative financing thing that I think we have any time to go over in this cast is option. Now, I would buy options sometimes on properties that I thought I could turn in a hurry.
Okay, explain the option, the process.
Okay, the option is I'm going to give you X dollars and for the right to buy your property for a fixed rate that we have agreed on and put in the document for a specific period of time. Let me give you an example. I look at this commercial corner, and I think, man, I think I can sell that to McDonald's.
Right.
So I give you $1,000 for the right to buy it for $50,000 anytime in the next 12 months.
And is there a specific timetable? Does it have to be 12?
Yes, but give me any timetable I want to be. That's negotiable between you and the seller.
Okay.
Could be 5 years. Could be 1 year. Could be whatever.
So you're giving them $1,000 up front?
Yeah.
Okay, for this
I'm
option.
gambling my $1,000
Okay,
that
so
I'm
it's
going
like
to be
a
able to
stock.
do something with the property.
Do you file this document? So
Yes, I usually
cloud
do.
it?
I usually do. File that. I usually file what do they call
Affidavit.
it? An affidavit, a notice of partial
Transaction.
interest. Yeah.
Okay.
Other than that, I don't worry
Equitable
about it.
interest.
Equitable interest, right? Exactly. I don't try to show them the document. Okay, now I got out here and I show the property, and the McDonald's buyer says, "Yeah, I'll give you $150,000 for it." Well, then I give the guys $50,000 and I walk.
With $100,000 for
Now,
$1,000
if he
option.
doesn't do it, I didn't give him $50,000 for a property that I can't sell. I gave him $1,000 and I just go down the road.
In the worst case scenario, you lose $1,000 in 12 months. So, I mean, this technique that you're using is really strong on lots, I'm assuming, and land.
It's strong on houses. Now, if you want to do something interesting, let's get about 20 $100 bills,
Okay.
and we'll go to a nice neighborhood in Edmond.
$2,000.
Yeah, we'll go to a nice neighborhood in Edmond, and we'll each take $1,000. We'll knock doors, and we'll say, "I'd like to buy your house." We need to do a little research, know what they sell for in that neighborhood.
Right.
Knock it down about $15,000, and so I'll give you the option to buy your house. Instead of being $250,000, I'll give you the option to buy it for $240,000 anytime in the next 12 months.
Awesome.
And most people will say, "You're crazy, I won't do it." But somebody's getting a divorce, somebody's getting transferred, somebody's getting something, and they'll take my $1,000.
Right.
Now, when they do, and I sell that house for $260,000 or $250,000, I make $15,000 or $20,000. So then the other 1 or 2 or 3 that I bought here, I lost on, but I subtract my losses and walk away with the profit.
So this is almost kind of like a wholesaling assignment fee of sorts, but it's called an option.
Yeah.
So instead of getting all the banks involved or private investors on a property that you know that you really don't want to hold or you don't want to keep or you're not going to rehab, but it's a decent, substantial deal, but that person that's selling it to you doesn't need the money right now anyway.
Well,
so that's your only
maybe they can't
hiccup.
sell it for what they're thinking. I mean, most of the time what they're doing is they're betting that you can't sell it and they get to keep your $1,000 in the house too.
So that's what they're
exactly you're appealing to them for their greed. You're waving that. You got to do it with cash. You're waving that cash.
So you just get a signed document, and then you just is it notarized?
Yeah.
Okay.
My wife's a notary.
Mobile
She's sitting in the car.
That's coming up on the side hustle, the mobile notary.
Oh, yeah, but I do that all the time. Anyway, that's a fast deal. My dad used to make a living between subdivisions in Dallas. He'd go to Richardson and Plano and those hot areas like that, and he'd option 3 or 4 of them in a weekend, and he'd get 1 or 2 of them sell, and he'd make $15,000-$20,000 a piece on them. And
I mean, what's stopping you from not doing a 5-year option?
Most people won't give it to you.
Okay.
They'll know you're going to sell it in that period of time.
And they know that you're going to profit. They're just content with the 1,000 and the purchase price that they're comfortable with.
Or they don't. Most of them don't think you're going to sell it. I'm gambling I can sell your house. I'm prepared to put $1,000 up.
But I love the concept because you tie it up. Because those people are trapped for 1 year.
I'm going to tell you one last thing. We're going to have to cut this one off. But I did a subdivision one time with an option. I went to the seller, and I said, I'll give you $500. This is years ago when I was a kid. I went to my dad and said, I need to borrow $500. I took the money back, gave it to the guy for the option, for 1 year option. On this piece of land, it was in Choctaw. It's called Mockingbird Hill Edition in Choctaw. You can go and drive down the street, Mockingbird Lane. And I said, if I can get the plat file, my banker says he'll loan 100% of the money to pay you off and put the road in. But if I don't get the plat file, he won't loan nothing. Mm-hmm. I'll give you, the guy wanted $30,000 for 30 acres. At that time, it was a long time ago, it was $1,000 an acre. Okay, so the guy agreed. I went to the surveyor and I said, I know you normally get like $2,500 for this, but I'll give you $5,000, but I'm only going to give it to you after the plat's filed. No money up front. If you don't get the plat filed, no money. He agreed. So he did a survey and engineering work, took that to the county, convinced them that the plat was good. They let me file the plat. I went down there, got the money from Fidelity Bank. I paid the land off. I paid Haskell Lemon to do the paving work. And while all that was being done, I went out to O'Hagan's and sold them all the lots for $7,000 a piece.
Wow.
16 of them for $7,000. And at the time, I had not one single penny of my money. I had $500 of my daddy's money, but I had no money of mine in the whole deal.
And I think that the creative aspect
but the option held it together while I could bring all the pieces in.
You know, and here's another one I'll elaborate, and we'll end with this one, is that I do that with probate attorneys. I was like, hey, I need you to do this probate, follow this probate, go through the probate. Let's work out a number now, $1,500, which is, $500 more than a normal probate, or I'll pay them $2,000 for probate.
They won't pay you nothing until it's over.
And these attorneys, they know they'll get their money because they'll cloud the title. They do their research enough, and they know that the complexity of it and the complexity of the deal. I do a side contract with that attorney, and man, I have no money in that probate. I only have my time in the deal and negotiating the deal with the people, the PR, the people that have the probate. And that's another creative way to get a deal done without money out of pocket.
We could probably do 20 shows on creative ways. We sat here and thought about all the ways there were.
We should pick specific. I know that an episode coming up, ladies and gentlemen, in a couple weeks or so is on cycles. I think we need to talk more about cycles. You've seen cycles in where are we going today, where we're going to happen. And it's interesting, I got in at 1999 creative financing because I was uneducated. But imagine when you said when the towers went down, in 2006 when the meltdown happened, man, creative financing probably was strong, and I was ignorant.
Was strong, yes.
Yeah.
And in 2001, I probably had $3 or $4 million of people who had said they'd give me a letter of intent that they would give me their 50 or their 100 or their whatever. But like I told them, I said, I can't just take your money. Mm-hmm. I need to go out and find a piece of property because we're doing secured mortgages, and until I find a property I want to buy, I'm sorry. And we numbered them. You're number 23, then you're next. And if you're number 25, then you're 2 deals down from number 23.
All right, we can go on all day, but listen, anyway. I learned one more thing from you right then. I always say your money's backed by mortgage.
Absolutely.
Nope. What Pat Pointon says, even better, secured by
Real estate.
Mortgage.
So it's secured by
The
a
word
mortgage on a piece
secure,
of
I
real
guarantee
estate.
the word secure will flip somebody from not being your private investor to a private investor by saying the word secure. That's what I learned from
The
you
difference
today.
between this and the stock market is it's secured investment versus a non-secured
I love
investment.
it. All right. Well, you if you've never heard us before, this is the Savvy Radio Show. You can check out other episodes. There's about 10 of them from the legacy that Pat's been leaving here on the Savvy Radio Show.
Thanks for listening to the Savvy Radio Show. Glide online and listen to our other motivating episodes at savvyradioshow.com. Connect on Twitter at LandlordBook and always be buying assets.